All right, Kenzo John Ag here with Market Acme, and I need you to stop whatever you're doing and focus on what I'm about to show you, because the data that just came out is going to blindside the majority of retail investors who are positioned exactly wrong for what's coming next. This is not speculation. This is not my opinion. This is not some sensational headline designed to get clicks. This is about a specific shift in institutional positioning that happened over the last 48 hours, confirmed by the CME FedWatch tool, verified by hedge fund flow data, and corroborated by a Bank of America survey that reveals the most extreme positioning we've seen since they started collecting data in 2012. I'm talking about a potential dollar repricing event that could devastate anyone who followed the consensus narrative over the past several months. I'm talking about rate cut expectations that are, in the words of institutional strategists, stretched, leaving room for a USD positive repricing that almost no retail investor is prepared for. And I'm talking about a timeline that gives you until June to understand what's happening and position accordingly before the market forces the adjustment, whether you're ready or not. Let me give you the specific numbers, because I want you to understand that everything I'm about to share comes directly from official sources and institutional commentary that you can verify yourself. The CME FedWatch tool just released its latest predictions regarding Federal Reserve interest rate decisions, and the numbers should make every dollar bear extremely nervous. The probability of the Fed cutting rates by 25 basis points in March stands at just 7.8%. The likelihood of maintaining the current rate is 92.2%. That's not a typo. The market is pricing a 92% probability that the Fed does nothing in March. Looking ahead to April, the probability of a cumulative 25 basis point rate cut increases to only 25.3%, with a 73.1% chance of rates remaining unchanged and just a 1.6% chance of a cumulative 50 basis point cut. Even by June, which has been the consensus target for the first rate cut, the probability of a cumulative 25 basis point rate cut is only 52.6%. That's barely better than a coin flip. Now think about what this means. The narrative that has dominated financial media for months has been that the Fed is going to cut rates aggressively, that inflation is under control, that the soft landing has been achieved, and that the dollar is going to weaken as rate differentials narrow. Retail investors have positioned accordingly. They've loaded up on assets that benefit from dollar weakness. They've reduced their dollar exposure. They've bet against the greenback based on expectations of multiple rate cuts. But the data is telling a completely different story. The Fed is not cutting in March. The Fed is probably not cutting in April. And even June is only a 52% probability. The rate cut timeline that the market has been pricing is collapsing in real time, and the implications for currency markets are enormous. Here's what Elias Haddad, global head of market strategy at Brown Brothers Harriman, said, and I want you to read this carefully. Quote, Fed funds rate cut bets look stretched, leaving room for a near-term USD positive repricing. End quote. He cited resilient economic growth and stubborn underlying inflation that remains above the central bank's 2% target. This is the global head of market strategy at one of the oldest and most respected private banks in the United States, telling you explicitly that rate cut expectations are too aggressive and the dollar is set to strengthen. This is not some fringe commentary. This is institutional consensus starting to shift, and the positioning data confirms it. On Tuesday, hedge funds trimmed their dollar shorts according to FX traders familiar with the transactions. This was reported by Bloomberg, citing sources who asked not to be identified because they weren't authorized to speak publicly. Options markets indicate that near-term bearishness on the greenback has eased, with front-end risk reversals at their least negative in almost a month. Let me translate that for you because this is critical. The most sophisticated traders in the world, the ones with the best information and the fastest execution, are reducing their bets against the dollar. They're covering their shorts. They're repositioning. And they're doing it while retail investors are still reading headlines about how the dollar is going to collapse. This is the pattern that repeats over and over again. Institutional players reposition first, quietly, without fanfare. Retail investors find out later, after the move has happened, when the headlines shift and it's too late to act. The question is whether you're going to recognize this pattern in real time and position accordingly, or whether you're going to be caught on the wrong side when the repricing accelerates. Now let me give you the context that makes this positioning shift so significant, because there's a piece of data from Bank of America that should terrify anyone who is currently short the dollar or underweight dollar exposure. According to a recent Bank of America survey, investors are the least exposed to the dollar since at least 2012, when data collection started. Read that again. The least exposure in at least 14 years. This is the definition of extreme positioning. When everyone is on one side of the trade, when positioning reaches historic extremes, the market has a tendency to violently reverse. This is not theory. This is how markets function. Crowded trades eventually unwind because there's no one left to sell to the bears or buy from the bulls. When positioning is this extreme, any catalyst that challenges the consensus narrative can trigger a cascade of covering that feeds on itself. And what's the potential catalyst? The Bank of America respondents identified it explicitly. Economic data that prompts a repricing of Fed expectations is the main potential catalyst for dollar strength. They're telling you exactly what to watch for. Any data point that shows inflation is stickier than expected, any jobs report that shows the economy is stronger than expected, any Fed commentary that signals a more hawkish stance, any of these could trigger the repricing event that catches the consensus completely off guard. The stronger than expected jobs report for January has already weakened the case for insurance rate cuts in the spring. This is according to Danske Bank analysts, including Chief FX analyst Jens Nervig Pedersen. They expect the Fed to cut in June and September, then hold rates into 2027. That's just 2 cuts this year, and then nothing for the entirety of next year. Compare that to what the market was pricing just a few weeks ago, multiple cuts starting as early as March, a Fed that would aggressively ease policy throughout 2026, a dollar that would weaken persistently as rate differentials narrowed. That narrative is collapsing, and the repricing is just beginning. Now let me introduce you to a framework that will help you understand why this repricing could be more severe than most investors expect, because there's a dynamic at play here that mainstream financial media completely ignores. When positioning reaches extremes and the fundamental narrative starts to shift, the adjustment doesn't happen gradually. It happens in violent bursts because everyone is trying to exit through the same door at the same time. The investors who are the least exposed to the dollar since 2012 didn't get there overnight. They built their positions over months, adding to their short exposure incrementally as the bearish narrative gained momentum. But they can't unwind those positions incrementally when the narrative shifts. They have to cover quickly before losses accelerate, and that covering creates buying pressure that drives the dollar higher, which forces more covering, which creates more buying pressure. This is the reflexivity that George Soros wrote about, and it works in both directions. The same dynamic that drove the dollar lower as bears piled in will drive it higher as bears cover. And when positioning is at 14-year extremes, the potential for a sharp reversal is at 14-year highs. Here's what makes this situation particularly dangerous for unprepared investors. The dollar has already weakened by roughly 10% since January 2025, when Trump started his second term. The Bloomberg Dollar Spot Index fell to a 4-year low in late January. Options traders have been positioning for further losses. The bearish thesis has been consensus for over a year. But during that entire period, the fundamental underpinnings of dollar strength never went away. The U.S. economy remained resilient. The labor market stayed strong. Inflation remained above the Fed's 2% target. The fiscal deficit continued to explode. But that's a long-term structural issue, not an immediate catalyst for dollar weakness. The dollar weakened not because the fundamentals justified it, but because of uncertainty around Trump's policies, particularly the trade war. Now that uncertainty is starting to fade. Danske Bank analysts point to declining investor concerns over the Fed's independence following the nomination of Kevin Warsh as the next Fed chair, as well as easing trade war uncertainty. The specific catalysts that drove dollar weakness are reversing, and the fundamental case for dollar strength is reasserting itself. This is the trap that's being set. Retail investors positioned for continued dollar weakness based on a narrative that was always more about sentiment than fundamentals. Now the sentiment is shifting, the positioning is extreme, and the fundamental data is not supporting the bearish case. The ingredients for a sharp dollar reversal are all in place. The only question is the timing of the catalyst. Let me show you what's happening in the Treasury market, because this provides another piece of the puzzle that most investors are missing. U.S. Treasury yields fell across maturities in early trade as markets continued to anticipate interest rate cuts by the Federal Reserve this year after data showed deceleration in January inflation last Friday. Money markets currently price in about 65 basis points of Fed rate cuts this year, with the first fully priced rate cut seen in July, while June also remains a possibility according to LSEG data. Now here's what's interesting. Treasury yields are falling because the market expects rate cuts, but the CME FedWatch tool shows that March and April cuts are essentially off the table, and even June is only 52% probable. There's a disconnect here between what the Treasury market is pricing and what the FedWatch tool is showing. One of them is wrong, and the adjustment when they converge could be violent. If the Fed doesn't cut in June, if the data doesn't cooperate, if inflation remains sticky, Treasury yields will have to reprice higher. That repricing will support the dollar because higher yields attract capital flows. And it will devastate anyone who is positioned for a dovish Fed that doesn't materialize. This is the scenario that institutional strategists are warning about. Rate cut bets look stretched. The economic data isn't cooperating. The Fed can't cut while inflation remains above 2% without destroying their credibility. And the market is positioned for a Fed that delivers rate cuts on a timeline that the data doesn't support. Now let me give you a historical parallel that illustrates exactly what happens when rate cut expectations collide with reality, because this pattern has played out before, and the results were devastating for investors who didn't see it coming. In 2023, the market was pricing rate cuts starting in March of that year. The consensus was that the Fed had over-tightened, that a recession was imminent, and that rate cuts would be needed to prevent economic collapse. Bond traders were positioned for aggressive easing. The 2-year Treasury yield, which is most sensitive to Fed policy expectations, had fallen sharply in anticipation of cuts. But the cuts didn't come. March passed without a cut. The Fed held rates steady. The economy proved more resilient than expected. Inflation proved stickier than expected, and the bond market was forced to reprice expectations sharply higher. The 2-year yield surged, bond prices collapsed, and investors who had bet on aggressive rate cuts suffered significant losses. The exact same setup is forming right now. The market is pricing 65 basis points of cuts this year. The FedWatch tool shows March and April cuts are essentially off the table. The economic data remains resilient. Inflation remains above target. And the Fed has every incentive to hold rates higher for longer to ensure inflation is truly under control before cutting. The repricing when expectations adjust to reality will benefit the dollar and devastate anyone who is positioned for the dovish scenario that doesn't materialize. So what should you be doing with this information? Let me walk you through the institutional positioning framework, because understanding the dynamics is only valuable if you take action. The first thing you need to understand is that consensus positioning is at historic extremes. When Bank of America tells you that investors are the least exposed to the dollar since 2012, that's a warning sign, not a signal to join the crowd. Historic extreme positioning is historically followed by sharp reversals. The question is not whether the reversal will happen, but when and how severe it will be. The action here is to reduce any concentrated bets against the dollar. If you've positioned aggressively for dollar weakness, if you're overweight international assets without hedges, if you've shorted the dollar or dollar-denominated assets, you need to reassess that positioning immediately. The risk-reward has shifted, and staying aggressively short, the dollar at 14-year extreme positioning is a recipe for significant losses. The second thing you need to understand is that the Fed timeline is not what the market has been pricing. March cuts are off the table with 92% certainty according to CME FedWatch. April cuts are unlikely at 73% probability of no change. Even June is only a coin flip. If you've positioned based on aggressive rate cut expectations, you're positioned for a scenario that the data does not support. The action here is to reduce duration risk in your fixed income holdings. If the Fed doesn't cut as expected, long-term bond prices will fall as yields reprice higher. The assets that have benefited from rate cut expectations will suffer when those expectations are disappointed. Short duration instruments and floating rate exposure provide protection against a repricing event. The third thing you need to understand is that the dollar's 10% decline since January 2025 may have been a sentiment-driven overshoot rather than a fundamental repricing. The specific catalysts that drove dollar weakness, uncertainty around Trump's policies, concerns about Fed independence, trade war fears, are starting to fade. The fundamental case for dollar strength, resilient economy, sticky inflation, Fed on hold, is reasserting itself. The action here is to consider adding dollar exposure, or at minimum, reducing underweight positioning. This could mean increasing allocation to U.S. assets, adding hedges on international holdings, or simply moving to neutral from underweight. You don't have to be aggressively long the dollar, but being aggressively short at 14-year extreme positioning is exceptionally risky. Now, here's where I need to complicate the picture, because I would be doing you a disservice if I presented this as a simple one-directional trade. The reality is more nuanced, and understanding the nuances is what separates sophisticated positioning from naive speculation. The dollar's short-term trajectory and its long-term trajectory may be very different. In the short term, over the next 3 to 6 months, The dollar could strengthen significantly as rate cut expectations are repriced and extreme bearish positioning unwinds. This is the repricing event that Brown Brothers Harriman and other institutional strategists are warning about. But over the medium to long term, the structural factors that undermine dollar strength have not gone away. The United States is still running $2 trillion annual deficits. The national debt has still crossed $36 trillion. Foreign central banks are still diversifying away from dollar reserves. Alternative payment systems like M-Bridge are still being developed, and the interest expense on the debt is still consuming an ever larger share of the federal budget. These structural factors don't create immediate dollar weakness. They create long-term vulnerability. The dollar can strengthen for months or even years while these imbalances build. But eventually, the mathematics assert themselves, and the adjustment, when it comes, is severe. This means the optimal positioning is not simply long dollar or short dollar. It's time horizon dependent. In the short term, reduce aggressive bearish dollar bets and be prepared for a repricing event. In the long term, maintain structural hedges against dollar weakness through physical gold and silver, commodity exposure, and international diversification. Let me explain this framework more concretely because abstract positioning advice is not actionable. For your short-term portfolio positioning, defined as the next 3 to 6 months, you should be reducing concentration in assets that have benefited from dollar weakness. This includes international equities without currency hedges, emerging market debt, commodities that are priced inversely to the dollar, and any explicit short dollar positions. The repricing event, if it happens, will hurt these assets. Dollar strength means international equity returns get reduced when translated back to dollars. Dollar strength means commodity prices face headwinds. Dollar strength means emerging market countries with dollar-denominated debt face increased servicing costs. Reducing exposure to these assets is prudent risk management given extreme positioning and stretched rate cut expectations. For your long-term portfolio positioning, defined as 18 months and beyond, you should maintain core holdings in physical gold and silver, commodity producers, and internationally diversified assets. The structural factors undermining long-term dollar strength have not changed. The repricing event, if it happens, will create better entry points for these long-term hedges. Use short-term dollar strength to accumulate positions at lower prices, not to abandon your long-term thesis. This is how institutional investors think about positioning. They don't bet everything on a single directional view. They separate time horizons, manage risk appropriately, and use short-term moves to improve their entry points on long-term positions. Now let me talk about what specific triggers you should be watching because the next several weeks will provide multiple potential catalysts for the repricing event. The first trigger is the Fed minutes being released this week. These minutes will reveal the internal debate among Fed officials about the timing and pace of rate cuts. If the minutes show more hawkish concern about inflation than the market expects, rate cut expectations will be pushed out further, and the dollar will strengthen. The second trigger is any inflation data that comes in above expectations. The market is pricing inflation continuing to decline toward the Fed's 2% target. Any upside surprise in CPI, PPI, or the Fed's preferred PCE measure will challenge that assumption and support the dollar. The third trigger is labor market data that remains strong. The January jobs report already weakened the case for insurance rate cuts. If subsequent employment data continues to show resilience, the Fed will have no urgency to cut rates, and the dollar will benefit. The fourth trigger is any Fed commentary that signals a more patient approach to rate cuts. Chair Powell's testimony, speeches by regional Fed presidents, any official communication that suggests the Fed is in no rush to ease policy could trigger the repricing event. The fifth trigger is geopolitical developments that reduce trade war uncertainty. The dollar weakened partly on concerns about Trump's trade policies. Any resolution or de-escalation of trade tensions removes a catalyst for dollar weakness and allows the fundamental case for strength to reassert itself. Any one of these triggers could initiate the repricing event. Multiple triggers in combination could make it more severe. The key is to be positioned before the triggers hit, not after, because by the time the headlines confirm the shift, the move will already be in progress. Here's what I want to emphasize because this is the core insight that separates prepared investors from those who get caught by surprise. The market is not efficient in the short term. It overshoots in both directions, driven by narratives and positioning that can persist beyond what fundamentals justify. But eventually, fundamentals reassert themselves, and the adjustment can be violent. Right now, the market has overshot in the bearish dollar direction. Positioning is at 14-year extremes. Rate cut expectations are stretched beyond what the data supports. The specific catalysts that drove dollar weakness are fading, and institutional players are already repositioning, trimming their shorts, reducing their bearish bets. The repricing event may not happen tomorrow. It may not happen this week, but the setup is in place, and the triggers are coming. The only question is whether you're going to be positioned appropriately when it happens. This brings me to the action steps I want you to take right now. First, assess your current dollar positioning honestly. What percentage of your portfolio is positioned to benefit from dollar weakness? International equities, emerging markets, commodities, gold and silver, short dollar positions? Add it up. If it's more than 30% of your total portfolio, you're concentrated in a crowded trade at extreme positioning. Second, consider reducing that concentration by 20% to 30%. This doesn't mean abandoning your long-term thesis. It means managing short-term risk appropriately. Take some profits on positions that have benefited from dollar weakness. Move to neutral on explicit short dollar bets. Add currency hedges on international holdings. Third, maintain your core long-term hedges in physical gold and silver, but don't add aggressively at current prices. If the dollar strengthens in the short term, gold and silver prices may face headwinds. Use any pullback as an opportunity to add at better prices rather than chasing here. Fourth, watch the triggers I identified. The Fed minutes this week, inflation data, jobs data, Fed commentary, geopolitical developments. Any of these could initiate the repricing event. Be prepared to act quickly when the catalyst hits. Fifth, subscribe to this channel and turn on notifications because I'm going to be covering these triggers in real time, providing analysis as the data comes out, and helping you navigate what could be a significant repricing event in currency markets over the coming months. Here's the question I want you to answer in the comments because this helps me understand where this community stands and what topics to prioritize. Are you currently positioned for dollar weakness or dollar strength? And how are you thinking about managing short-term versus long-term positioning given the dynamics I've described? Let me know because the feedback from this community shapes the analysis I provide. The CME FedWatch tool shows March rate cuts off the table with 92% probability. Bank of America data shows investors at the least dollar exposure since 2012. Hedge funds are trimming their shorts. Institutional strategists are warning that rate cut bets look stretched. The fundamental data, resilient economy, sticky inflation, strong jobs market, does not support aggressive Fed easing. These are not opinions. These are facts you can verify from official sources. The only question is what you're going to do with this information. You can stay positioned with the consensus, betting on continued dollar weakness and aggressive rate cuts that the data doesn't support. Or you can recognize that extreme positioning combined with stretched expectations creates the setup for a sharp reversal and adjust accordingly before the catalyst hits. The repricing event may give you until June, when the market finally gets clarity on whether the Fed will cut, or it may happen sooner if any of the triggers I identified materialize. Either way, the time to prepare is now, not after the move has started. Share this video with anyone you know who has positioned aggressively for dollar weakness over the past year without considering the risk of a reversal. The people who get hurt most in repricing events are the ones who followed the consensus without questioning whether the consensus was right. This is Kenzo John Ag with Market Acme. The setup is in place, the triggers are coming, and the positioning is extreme. What you do with this information over the next several weeks will determine whether you're on the right side of the trade or caught in the crowd when the repricing hits. I'll see you in the next video.